This is Morning Trade Live, and I'm glad you're with us. Now it's time to focus on the macro picture. What happens next? Yelena Shulyatyeva is with me, senior U.S. economist for the Conference Board's Economy, Strategy, and Finance Center. Thank you so much for being here today. Look, we're coming off of a big jobs report. We got a factory orders print today. We'll get lots of pieces, but certainly that jobs report was huge. A quick thought there.
Well, the economy is slowing down, and that latest payrolls report just confirms that. I would say that following those sizable revisions to the previous 2 months, the data actually makes more sense, given that growth already was seen as slowing down. So previously, we were trying to, kind of understand why the data is not trending the way it should, given a significant slowdown in the economy that was reflecting in the latest GDP numbers. But now it kind of all puts it all together. The economy is slowing down. Companies are slowing down investment. They are freezing hiring in face of significant uncertainty, particularly on the part of tariffs. So now the hope is that with that removal of uncertainty, even as tariffs are going up, companies will kind of like decide, okay, we know what to expect. We have more or less, a good understanding of what's ahead, and we could, adjust our investment plans and hiring plans and proceed slowly. And that's our expectation.
Right. Understood. Just to stay on the jobs, I want to get to factory orders and some other things. But the big picture here, labor force participation rate came down a little bit. Are we concerned about how consumers may behave back to school, the holidays? What do you surmise?
Yes. So in terms of the payrolls report, you have a significant slowdown in demand for jobs. But at the same time, you have a significant, decline in the supply of jobs, right? A supply of labor. So that's why, those two are balancing each other, and you don't see a significant deterioration in terms of the unemployment rate. So the unemployment rate only increased by 1/10 in the latest payrolls data. Payrolls did see a significant slowdown, though. So that's what we see in our own consumer confidence data as well, that the labor market is slowing down. There were 7 consecutive declines in our jobs availability index in the Conference Board survey. So consumers are feeling that jobs become less and less available, and they're worried about it. So the consequences of that is that we may see a slowdown in consumer spending. In fact, in the second quarter of the year, we already saw quite a significant slowdown in personal consumption. And as you rightly mentioned, going into the back to school season and later going into the holiday season, tariffs will raise prices, and that would weigh on consumer spending in real terms. So what we expect is quite a significant slowdown in economic activity in line with what we see in the labor market.
Right. I mean, factory orders today came in minus 4.8%. The estimate is minus 4.9%. Does that show you something as well? Does that go with your story?
These numbers is just kind of like a final release from the data that we already saw earlier on the 25th of July when we got durable goods orders. It's just a confirmation of a slowdown in investment activity. So again, companies in the second quarter of this year were puzzled by how much tariffs would rise eventually. Where we end up in terms of the rate and the magnitude of tariffs. So it's not surprising to see that new orders like investment activity is slowing down. So the headline number in factory orders reflects a significant drop in Boeing orders in the months of June. But if you look beyond that, the underlying pace of activity is also declining. So core capital goods orders, ex-aircraft, also decline. And that tells you that going into the third quarter of this year, we will continue to see some weakness in capital expenditures as consumers also slow down. And that all tells us that perhaps the second half of this year is not going to look great, which will make the Fed eventually cut rates later on this year.
Right. I want to get to the tariffs. I want your thoughts there, especially as they'll start to kick in now, August 7th, as well as the Friday date for Russia, sort of D-Day deadline date. As I think about all these other countries, tariffs and the Friday date come to mind. Some thoughts?
So yeah, in terms of tariffs, I mean, the good thing about it all is that we definitely have more clarity about the direction, about the size of tariffs. So that could help companies actually going into the next year to decide what to do. I don't think that will actually cause much of reshoring. You know, the rates at this level probably will not result in a lot of reshoring of manufacturing back into the United States. But that would mean higher prices going into back to school, into the holiday season, particularly on the back of the latest round of tariffs. So what it would mean is, a significant hit to consumer spending activity, particularly in the fourth quarter of this year. Now, these tariffs take time to filter through into the economy. And I guess the latest round of tariffs would also mean slower activity in the beginning of next year. So that's what comes into focus right now. It's, we're already more than halfway through with 2025. So now we're looking ahead at what happens in the beginning of next year. And, it looks like some weakness will linger into the first half of next year, just based on all these recent developments.
All right. Well, it's great to see you. Thank you so much, Yelena Shulyatyeva.
My pleasure.
It's really nice to have you on from the conference board. Appreciate it.